Is your money safe in banks? Within 1.5 weeks, 3 banks have collapsed in the US. Then later in the same month, 2 more banks were in danger of sharing the same fate. Should I be worried? Is this the start of another financial crisis? Or are these random, unconnected events? All these questions will be answered in this video. And I will also share with you what I've done to protect my family against bank fails. On the surface, we could blame the collapse of Silvergate, Silicon Valley Bank, and Signature Bank on bank runs, when a large number of depositors withdraw their money from banks at the same time. Customers of Silicon Valley Bank withdrew $42 million within 48 hours. But what made these customers take out all of their money in the first place? Silvergate had a huge customer base who made their money from cryptocurrency. Ever since regulators started investigating Silvergate's involvement in the FTX collapse, waves of Silvergate customers withdrew their money, which eventually led to Silvergate announcing its liquidation on 8th of March. On the other hand, most of Silicon Valley Bank's customers were US technology startups. The tech industry has taken a massive financial hit, so many of their customers started to take their money out to weather the bad times. Silicon Valley Bank didn't have enough cash reserves to cope and was forced to sell its assets, but at a loss. Rumors that Silicon Valley Bank was in trouble spread. With the help of 24/7 digital banking and panic spreading on social media, things happened very quickly. And in less than 2 days, panic customers have withdrawn enough funds to cause the collapse of Silicon Valley Bank. Fear is contagious. 2 days after the collapse of Silicon Valley Bank, customers of Signature Bank got spooked and started withdrawing their money as well. Regulators had to step in and shut Signature Bank down, and it didn't stop there. Another US bank, First Republic, was on the verge of sharing the same fate as the other 3 banks. Scared customers did a bank run which caused their share prices to plummet 70%. Then at the 11th hour, First Republic was rescued by some of the United States' biggest banks by them injecting $30 million of deposits into First Republic. Whew. That was close. So did these banks collapse because they were connected to riskier businesses like startups and crypto? On the surface, it may appear that way, but there's a deeper reason. Both Silvergate and Silicon Valley Bank had a huge chunk of their assets in long-term investments like government treasury bonds. Silvergate invested 80% of their deposits in long-term bonds, with the majority being bonds that matured over 10 years. And Silicon Valley Bank had 55% of its assets in fixed income securities. And the industry average is only 24%. Fixed income securities like treasury bonds are investments known to give smaller fixed returns because they're considered low risk. But even low risk investments are not without risk. The catch with bonds is that their value moves the opposite direction of interest rates. As interest rate decreases, their value goes up. And as interest rate increases, prices of fixed rate bonds fall. The bond investors can still get a good return if they hold their bonds till maturity. Do you see the problem that Silvergate and Silicon Valley Bank were facing? Both banks didn't have the cash reserves to cope with the bank run. To be fair, no bank can cope with all their customers taking all their money at the same time. Not even the healthy banks. Because banks don't have 100% of their customers' money just sitting there. In order to meet the demand of depositors taking their money out, banks might need to resort to selling their assets. And unfortunately for Silvergate and Silicon Valley Bank, they had to sell long-term bonds that haven't matured yet, during a time when the Fed is having a frenzy with raising interest rates. So the real reason why Silvergate and Silicon Valley Bank collapsed was because of the lack of investment diversification and lack of liquidity during rapidly rising interest rates. And exposure to rapidly rising interest rates is impacting the whole banking sector, not just banks connected to tech and crypto. This contagion didn't just impact banks in the US. And stay tuned because I will be sharing my plan B for bank fails. Our systems are all interconnected. So across the world in Switzerland, the walls started crumbling for Credit Suisse. Credit Suisse was one of 2 main banks in Switzerland and was one of the global systemically important institutions, which means they are considered too big to fail, because if they did, then that would trigger a global financial crisis. Problems started in Credit Suisse several years ago, and regulators were watching closely. Shortly after news of the bank's collapsing in the US, the takeover of Credit Suisse by UBS, the other main bank in Switzerland, was announced. The repercussions of Credit Suisse's collapse might have been contained by the UBS takeover, but only time will tell the full impact of the events on the global economy. So, should we start panicking? Let's put things in context. The Federal Deposit Insurance Corporation is an independent agency created by the US Congress to maintain stability and public confidence in the United States financial system. And on their website, we can see a list of all bank failures in the United States from 2001 and 2023. And have a guess how many bank fails were in the United States during that time. Did you guess right? 562 banks. That's a lot. So even though bank collapses are bad and should be taken seriously, they are more common than we think. And rather than panicking, which doesn't help anyone, it's more practical to understand what protection measures are in place so you know where you stand. In the United States, the Federal Deposit Insurance Corporation protects deposits for up to $250,000 per depositor per account. So if you had more than $250,000, then just have more accounts in different banks. But be aware, not all banking institutions or types of financial accounts are insured. There's a list on the FDIC site, so you can check whether your institution is insured. In Australia, the Financial Claims Scheme protects depositors of up to $250,000 as well, per account holder, per authorised deposit-taking institution, in case they fail. And this includes bank, building society, or credit union. The catch is that the $250,000 limit applies to the total amount of an account holder's deposits with each banking institution. And this is really important because some banks operate under different brands. So you might think that you have different accounts with two different banks, but actually both accounts are with the same bank. Deposit protection schemes and the conditions can vary in different countries. So please do your own research. And now coming back to our initial question, is your money safe in banks? And to be honest, I can't answer that question. No one can give you 100% guarantee either way, but it's still wise to take action just in case. I've done two simple things to help manage the risk around bank fails and protect my family. Number one is diversify. We have accounts with different banks, so in case one bank starts collapsing, then we have the option of transferring our funds to another bank. Number two is have cash. With the deposit protection scheme in Australia, we're not that worried, but because things always take longer than you expect it to, it's probably going to take time for funds to be made available. So we have some physical cash to cover expenses during the waiting period. And how much physical cash do we have in hand? Enough to cover bills and keep things going for 1 month. Do you think there's a financial crisis around the corner? And how do you plan to protect your family? Leave your comments below. Thanks for watching.